But does that even make a difference? Like the US has to issue at least $3 trillion next year just to reissue bonds that were issued on a short-term basis, plus the deficit that needs to be financed. Credit event, I think, is the buzzword I'm going after here, Michael. Is like when we talk about that. I'm asking for your definition just to clarify it for our audience because you haven't been on in 12 months, Michael. And B is like, are we running into a credit event / liquidity crisis this year?
I don't know. I've been wrong on that. I thought the reverse carry trade was going to be the catalyst. Again, it was for 2 days. The VIX hit 65 very suddenly, right? I mean, and I got I got 20,000 followers on a single day because everyone knew I was the guy that was adamant about the reverse carry trade, and I still think it's out there. But I don't know. I mean, this whole environment has been very frustrating because a lot of the historical stuff is not, in quotes, working the way it was prior. There's not as much co-movement. If you have small caps really start to run, which again I would love to see, then yeah, a lot of that gets postponed. I think. I mean, look, a credit event by definition is just a VIX spike because credit spreads correlate to volatility in equities. That's all it is. It's not some scary thing. It's what I'm saying. It's the tail event, which is the way markets behave. Obviously, my timing has been very wrong on that, and I go back to the reason I think is because of Yellen. Okay, but could it still happen? Sure, and candidly, it probably happens when I give up on the idea. That's always how it works.
That's always like once you change your mind, you say, it's going to look something different, and then it just happens, right?
Selling the low. That's what it is.
Absolutely. And there's like we haven't talked in a while, Michael, but the disconnect between the economy and the markets. Like the markets, of course, running at an all-time high. Economic data, like if we take it at face value, looks all right. Like, does the market and the economy make sense to you at this point, or is there still a massive disconnect?
Well, you said it correctly, at face value. Right? It's like, how many revisions are there out there? Does anybody really have a clue what the real state of the economy is? Because I would tell you what, small caps, if that's a clearer sense of the real state of the economy, have been saying, yeah, it's okay. It's not phenomenal. Right? I mean, small caps are much more tied to the domestic U.S. consumer than large caps, which are multinational. So if you want to make a play on the U.S., you're making a play on small caps. It hasn't really worked that well. I'd rather use market prices than economic data from policymakers that are trying to stay in power.
Talking about those indicators, like have they changed over the last 12 months for you? Like, have you weighted them differently? Like, are you giving more weight maybe to inflation data, unemployment data? I'm just, I'm not trying to put words in your mouth here, Michael, but curious, like if that's changed at all.
I use a lot of market, intermarket signals, right? And the way I tend to kind of form a thesis. People will say, oh, your lumber to gold signal has been wrong. There's no predictive power. It's like, that's stupid because you can look at the white paper, which is pure fact on that. And actually, as a matter of fact, lumber to gold has actually worked out very well. What has not worked is the expression of treasuries against that signal. That's a whole different discussion. So no, I mean, to me, I still believe that there's cause and effect. I still believe that when utilities outperform the market, that tends to be a defensive signal. I still believe when gold is outperforming lumber, that tends to be a defensive signal because that belief is proven in history outside of the small sample of the last year and a half where treasuries have failed independent of whatever signal you followed as a risk-off option because you've had no real risk-off because credit spreads have stayed tight. I mean, that's just the reality. As far as economic data goes, I don't know. I don't think any of it matters. I think this is a pure liquidity-driven type of environment. I think it's a pure leverage-driven, which is part of liquidity-driven environment. I've used that line many times before on X, and I maintain this, even though it hasn't happened, obviously, yet. The precursor to every crash is leverage. The precursor to leverage is overconfidence that the current trend persists ad infinitum. And I go back to, we have never been in such a bull market for recency bias in history. And I think that's at some point going to kick everybody in the pants. I don't know when. But I'll probably be loud on X whenever it happens. That's the one thing I do know.
We'll probably see it and hear it to degrees, like even just capital letters. I'm sure there'll be a lot of use of capital letters here.
I don't know, man, because now apparently that algorithm change is coming, meaning I have to be positive. So I'm going to say it's exquisite as opposed to the other F word. That's not
hashtag sarcasm, right? Just just preface everything with that, and you should be fine. I've looked into the algorithm changes yet and that are planned here, but it'd be interesting. Risk off wise, like you mentioned 4 categories last time. Treasuries, gold were 2 of them. What are your favorite risk off trades right now? Like, how are you hedging?
Well, again, so in terms of the strategies I run, which are rules based, those are not based on what I'm thinking, right? It's using long duration treasuries. I do think gold probably still has a lot more room to go. I mean, I still maintain that gold is the ultimate diversifier because historically it doesn't correlate to very much. It kind of marches to its own beat. Not a lot of leverage in the gold market because people are leveraging crypto and Bitcoin instead. So I think gold still has that counterparty attractive aspect to it. I do worry about the dollar continuing the way it's been continuing. Now maybe it's a top or close to a top. But if the dollar were to keep on rising, that is going to be a self-fulfilling risk-off play because it creates this almost short squeeze dynamic where it creates some funding stress in international borrowers. That financial stress then results in the dollar even going up further, and then it's like a blow off in the dollar.